All right, we're about 2 minutes away from getting this thing going. We got some people already sitting there patiently waiting for us to get it started. Feel free to check in the chat. Happy to give everyone a shout out. A couple more minutes and we are going to get this thing underway. All right, there we go. We got Cash Money, first person to be checking in and joining us tonight. We got more for checking in every single week. Happy to see it. 15 seconds away from getting it going. We're going to hope we don't have any technical difficulties that have plagued us for the last couple of weeks. I think I finally come around to the idea of getting a new laptop that can handle this, so hopefully that doesn't happen to us in the future. 1 second. There we go. We are getting ready to get it started. I'm going to X out of the notification. We got a new face in the chat, Emily G, who has just joined the server this week. Happy to see you guys. JM shouting out the 49ers. I love it. They had a real good game today for about, most of it. I think they're up about 20-something points at the 2-minute warning, and then they almost blew it. Miguel in the YouTube chat, how's it going? All right, so we are going to kick this thing off. I guess I should first say thank you for coming and joining us again on another weekly trade idea stream. We are going to start this thing off the way that we always do for those of you who are new here by just giving a quick recap of the past week in the stock market. Then we're going to talk about, whatever we think is interesting for the upcoming week in the market as we, dig into our scanner, take a look at upcoming earnings, maybe get some stock ideas from you guys in the chat that we could do some analysis on. And we will kind of go from there. So, the more the merrier in the chat after we get through the recap. This could really take any direction that it gets steered into. So we will get this thing underway. I always say that I'll try to make it quick on the recap side of things, and it always gets dragged out, but we will put that to the test because I'm kind of already rambling off the bat here. Diamond Handsies, how's it going? But let's get it started. So biggest thing last week was the S&P 500 took a pretty big dip, dropping 1.69%. Obviously the dips can get bigger than that, but compared to how it's been over the past year or so, this is, a decent sized dip. Still doesn't quite register on the doesn't quite register when you look at the 1-year chart of the S&P 500, which we can take a look at later. So it's always important to remember that things can get worse, but main takeaway from the week is that we still pulled, in spite of that 1.7% drop in the overall market, we pulled a 0.68% return, meaning we outperformed by 2.37%. So it was an awesome week for us. With that said, let's take a quick rundown. UWMC, we've been in this one for a while. We were happy to sell these for, I think, about $1.10, $1.15. Forgot the exact amount that we sold these for. But they've got a really nice break-even price on them. So we're happy to let these ride out until their December expiry, which is coming up sooner rather than later. I feel like every time I look at the calendar, I am just more and more surprised at how close we are getting to the end of the year. This next trade is one that I definitely want to talk about because I think this is a super interesting one that we opened up this week. Definitely a little bit larger of a position for us as it takes up about 41.54% fully cash secured. But we're going to talk about why we think that's okay. So let's pop open Thinkorswim and we can get into the analysis on that one, Rocket Lab. So if we go to RKLB, come on, we'll have the chart for Rocket Lab. So it used to be a SPAC, they just underwent a merger. And if we zoom out on this, you're going to see the typical chart that you'll see on a SPAC, right? Pretty hard support around 10 because that's the net asset value on the stock. Theoretically, that's the amount of cash that the company is holding. So it can't really go any lower than that, until the acquisition. And then we had the acquisition. They are now trading under the new ticker RKLB. And we see this huge spike in stock price. And with that spike in stock prices, we could see plotted down here by this blue line is our best friend implied volatility, which is also rapidly moving upwards. And when implied volatility moves upwards, we know that the premium on options that we can sell increases, meaning that we can get more money for options that we sell, which is something, we always like. We like getting as much money as we can. So with that in mind, how do we play this back down? We know in general, we just don't like trading SPACs that are too far above 10. So whatever trade that we pick to get in on here, we want our break-even price to be below $10 a share. So if we look at the weekly premium, we can see these are expiring next Friday. There really isn't a lot of premium available down around $10 or down around that $10 strike. Now, you could make the argument if you wanted to sell, one of these 11 strike puts for 10 cents. That's not too bad of a deal because you're coming in just south of a 1% return on risk on a weekly basis, which we know is a really nice return when you put that into the context of what that would be annualized, a 1 week 1% return over and over and over. But that really wasn't quite doing it for us. So what we did here was actually kind of interesting. We went a little bit further out. We went out to January 2022, which seems further out because the whole year, January, that's like the leap expiry, right? It's a year away. But if we look at the calendar, it's really only 4 months away, right? We have October, November, December, and January giving us pretty much 4 full months until we get to this January 21st expiry. So while it is longer term in the sense we went out to January, it is kind of, relatively speaking, coming up soon for what used to be a longer expiry option. And what we did here is we sold a 7.5 strike put. We sold 75 off the bat for I think 75 cents, and then we averaged in with 25 more to get our average price on these up to an 83-cent credit. So it finished trading at about 90 cents. I think it might even be lower than that. Yeah, it's about 88 cents right now, and I think we've updated that for the upcoming week. So, you see this $700 loss right here, and it's really a $500 loss when you net it against that. Excuse me. But, we're not too discouraged about that because in plain English, what do we know about a 7.5 strike put if we get 83 cents of premium? The answer is that our break-even price is that 7.5 strike put minus that 83 cents of premium, meaning we have roughly a $6.70 break-even price on this. So as long as it finishes above $6.70 come January of next year, so 4 months from now, we're going to make money on this trade overall, so we're not too concerned about it. But you might be saying, HT, you always preach that you like to use these shorter term expiries. If you just look at our trade history, we're playing all of these shorter term expiries. What's the deal with going out to January? And to build a little bit off the first point we made where we didn't like the amount of premium that we saw on the September 17th expiries, what's great about these when implied volatility spikes as high as it does when we look at the chart and you see it getting up to the 1.6 range, is that implied volatility, I feel like we say it every week, it's one of those things where what goes up must come back down. And when this comes back down, this option premium is going to melt away. So let's take a look at the price action on this 7.5 strike put over the last couple of weeks to maybe get an idea of where we think this might settle. So if we get a more info, TOS charts, plot this side by side. I want to put these both on a 20-day time frame. And there you have it, right? So it was trading at 145 for a bit, and it got all the way down to 65 cents a piece back on September 9th right here. And if you look at September 9th on the chart, that was last, I think, Wednesday, Thursday, Friday. Yeah, it was last Wednesday. So not too far away. And this is back when the price was at $15 a share. So theoretically, if the price of the stock goes up, the price of the put should go down. But what we saw here, interestingly, is that when the price of the stock went up, the price of the option also went up to about this $1 range. And, we got settled in. We didn't time it perfectly, but you're never going to time and trade perfectly. So we have an average at around 83 cents a piece. But the idea is that, when the stock was trading at 15 a piece, implied volatility was down to this 1.3 level. Now it's trading even higher, and implied volatility is at this 1.6 level. So if implied volatility falls back down to this 1.4 level, and it just holds even the $15 level, we potentially could expect to see, a 65 to 70 cent range on this for something that's trading at 90 right now. So as far as profit is concerned, what does that mean for us, right? With this trading at 88 cents, if this drops all the way back down to 0.65, which is, a range we potentially could reasonably expect it to return to at some point here in the near future. If this loads right here for us really quickly, there you go. That's $2,500 of profit based off our position size, just off of it, quickly falling back down to where it was on September 9th, which is where that price was with the stock at 15 apiece. So we have really a $3 cushion from where we think our base is, and all the time in the world, quite frankly, because even if it falls through this $15 price level, like we mentioned at the top of this discussion, as long as it finishes above 670 come January, we're still going to make money overall in the trade. We might just have to wait a little bit longer than we had initially intended. So as far as an exit is concerned, we know where we could reasonably expect this to bottom out once implied volatility pulls back. So we think maybe this 60 to 65 cent range would be great for an exit this week. And like we pulled up on our profit tracker, if it got back down to that 60, 65 cent range, we're going to see a $2,500 weekly profit. So, moral of the story here is that even though we played a longer dated option, we made a little bit larger of a position, but one of the benefits from a margin perspective about this larger position is that it requires a lot less collateral as opposed to selling it fully cash secured. So we have that advantage. We're not tying up a lot of cash to let this thing sit in the back of our portfolio and go to work, but rather we just put 15 grand up. And don't let that number scare you, because we sold 100 of these. You could just as easily sell one of them or two of them. Position sizing doesn't really matter here. What we're really trying to pay attention to is the percent returns we're getting, and these are really, really nice if you're looking at a $2,500 weekly return off of $15,000 of collateral. So, that's the number we're trying to focus on, the percent return that we're going to get. And we can, set up a pretty high percentage play just off the idea of implied volatility falling back down to these levels that it's previously traded at that we could see on the chart. And hopefully we could find some sort of exit here in the 60s in the upcoming week. And again, if not, that's perfectly okay. We're going to sit back. We'll wait until we get that exit we want. And you might be saying, how do you know something like this is going to happen? Do we have something that we could compare it to? And the answer is actually going to be SoFi, because it was in a really similar situation where SoFi was a former SPAC. We could zoom out to, I think, the 180 days, probably the best way to look at this. Back in July, it was shooting way up past 20. So there you go. You have an example of a SPAC similarly to Rocket Lab, where it shot up from the $10 net asset value up past 20, which is about where Rocket Lab got. And if we go to the trade for SoFi and take a look at, we could take a look at the same thing. We could take a look at January 2022 7.5 strike calls. So if we pull those up side by side, put them on a similar time frame, you'll see something really similar, right? So for whatever reason, this only pulls up back in June. We can see the date right here. It pulls up starting June 2nd. So let's, crop this chart to pull up and start June 2nd. So you're going to see something really similar to the setup that we have with Rocket Lab. And it's the fact that you had this SPAC with the $10 net asset value that shot up into the 20s, low 20s, and Rocket Lab pretty much, I think it did cross 20, got near 21, I think, at the peak. So really similar setup. And even after, the next month or so, you could take a look at what happened between then and July 2nd, when it dropped from 23 down to 18. It dropped $5 a share. Yet between June 2nd, where you see this was trading at about 50 cents a piece, and July 2nd, where it got down to about 30 cents a piece, it lost almost half of its value despite a decrease in the stock. And why is that happening? If we take a look at the blue line right here, it's because of that sharp drop off in implied volatility. So, we really have two things working for us. The first is just the way that the cash secured put itself works, and the fact that, if this doesn't get back down to $7.50 a share, we're going to hit max profit. But the second thing we have working for us is the implied volatility elevation that we currently are seeing on Rocket Lab, which eventually is going to come settle down the same way that SoFi did. And if Rocket Lab can find a home anywhere in this, 15, 16 range like we saw with SoFi, you're going to see similarly a dramatic drop off in the premium on the 7.5 strike put, which, SoFi went down from 0.55 to, 0.1 right now. This thing is so elevated at 0.88. For it to fall back down to 0.1 in just a matter of a few months wouldn't be too far out of the question. Again, if it just stayed in this 15 range. Is that going to happen? I have absolutely no idea. But, we'll sleep easy at night knowing that our break-even price is right around here. So pretty good value proposition right there. We're just going to watch this one on a day-to-day, week-to-week basis. Monitor that premium because, as you can see right here, small moves in the premium, even if it comes back down to 0.7 for this upcoming week, that's still a $2,000 profit on a 1-week basis, which is a very, very nice return. So we're perfectly happy to hold on to that one. Keep monitoring it, stay patient, wait for a good exit, and, get out of it with profit when we see it. So continuing the recap, since that one probably was the longest one that I would have had to talk about during that weekly recap right there. CRISPR, another really good one. This has been expiring worthless for us week after week after week. We love this 110 to 115 range to be selling cash secured puts at, and that's probably something I'm going to look to do again come tomorrow morning. Clover Health, these 8-strike puts cruised to max profit because that one shot way up for us if we pop the one chart back into full view right here, CLOV. You'll see if we zoom in a little bit more so you can see what happened recently. It shot up to 11 at the peak, and our max profit point was down at $8 a share. You could ignore these drawings right here because those are old. But yeah, our max profit point was right here, and it never really got threatened. In fact, what happened at the end of the week was kind of nice for us because a stock that we love to play off this $8 level seemed like it was running away from us as it started testing 11 a share. But within 3 days, it pulled back to 860, which threw some premium in the weekly options for this week back at 8 again. So that 1.98% ROR, really attractive from an investment standpoint. I would not hate the idea of jumping in on some more of these come Monday morning. So that might be something that we look to do because historically, if we take a look at this chart, every time it gets down near this $8 level, and if we want to draw the 8 right here, that'd probably be pretty useful. Every time it gets around that level, we can see it keeps bouncing off of it, It did break below it once, but it rebounded quickly to get back up to where it is at this, seems that it's found a home in the 8 to 850 range. So if we sell 8-strike puts, those are going to turn out pretty well week after week after week. And that's what we've been doing week after week after week. 210 profit there, 110 profit right there. Whatever we had this week, we had a lot of these that week. 760 profit right there. So just in the last 3 weeks, from taking a look at this chart and identifying this opportunity for premium, we pulled about $1,000 of profit. That was relatively low stress just from those 8-strike puts. So that's not something that we would hate to get back in on come tomorrow morning. So moving further down the list of what we did last week, ZEV, that's one that we're going to keep holding on to. That one's, clean above 9. I don't know where exactly it finished. I think it is, it's not on my watch list. Whoops. ZEV closed at 993, right? So it's right around this 10 level. These red lines represent max profit and then our break-even price. So we look like we're going to be cruising to more profit on that this week. And you might say, why don't you close out early? The answer to that is because, looking at that chart, it's so far and away above these 2 red lines that we've drawn. And if we hold on and let these things expire worthless, that is going to be, $150 of profit for us on the week on what should be a relatively low stress option expiry. So that's why we're holding on to that. FFIE, another one we've been going back to the well again and again and again on. And one thing that's really cool about FFIE is, if we identify opportunities where the premium is good enough, you kind of get to the point where the general trend in the stock price is irrelevant. So if you take a look at FFIE, we're going to pull the chart up over the last, let's look at the last trading month. And you can see, decent downtrend, right? Maybe we need to zoom out a little bit further. But yeah, decent downtrend. Coming down from 13 to 12, 11 to where it's currently trading at about $9 a share. There isn't a lot of upward movement in here. And we know when we sell cash secured puts that it's a neutral to bullish trade. So if you take a look at a chart like this and knew that you had a neutral to bullish trade on it, you probably would think that you made money. But you probably would think that you lost money because the stock was going down, week after week, day after day. But the great part about FFIE and the premium that these options are offering is that, we've pretty much been playing at this whole window that we're looking at right here. And I'm not certain that we've lost money on it a single week yet that we've been playing it, right? We had FFIE for 225 profit this week. We had it last week for 190 profit. Had it the week before that for 315 profit. And then we had it the week before that. That one got a little dicey because it dropped on us, but, still $200 of profit. And we started selling these puts, as you can see right here, at a 10 strike. And then as it dropped, we were still able to take profit and sell a 9 strike. And then the week after that, we were able to sell an 8.5 strike. And come to current week when we're now able to sell an 8 strike put. So week after week, our max profit target on this keeps getting lower and lower and lower, starting at 10, getting down to 9, 850. And now for this upcoming week, we're going to be selling 8 strike puts. And I think this is a really good setup. These are going for between 20 and 25 cents of premium on a weekly basis, which I think, even that alone, I cannot even begin to wrap my mind around, because I think that is just some incredible value for a 2.89% return on risk, fully cash secured. And, we could remove these because these are going to be old drawings. Remove drawing. We're now in the situation where we sold an 8 strike put. So our max profit point is going to be that $8 price level right there. We sold it for about 25 cents a pop. So that 775 level is going to be our break even. And we've got that for the next 5 trading days. So if you take a look over the last, month and a half, it hasn't really dropped below that 850 level. We now have a max profit point at the 8 level. And as long as FFIE is offering this kind of option premium, we are going to go to this one week after week after week. Similar to Clover Health, where, it may not be the best company in the world, but with the amount of option premium that you're getting offered on this one, it's just opportunity and value that you can't really pass up on a week-to-week basis. So for this one, okay, it looks like 21 cents is what we sold them for. So if these expire worthless, we're going to hit 210 bucks a profit. But, obviously a lot of these plays by themselves aren't typically groundbreaking, but, you add up max profit on ZEV, you add up max profit on FFIE if that hits. If RKLY finishes above 750, which it's well on track to, these things start adding up, and we're moving towards what would be a $1,000 a week just off of some of these that we've been rolling forward on a week-to-week basis. So, that's the idea right here. We're not trying to put too many of our eggs in one basket, unless it's something like RKLB where we think we have a decently solid investing thesis and have some precedent, like with what we saw on the SoFi chart, for entering into this trade. But down here is where we like to just, small gains, add them up. You can see what we've been doing on a week-to-week basis, right? All of these new trades that we alerted in our premium Discord server, these are pretty much hitting. NRXP is really the only new one that missed, but again, this rolls into next week, and as long as it finishes above 10, that's going to be max profit. So basically the ones that did wrap up last week are carrying over, basically 13 for 13. You could see the trend week after week. ACIU is really the only one loser that we've had in the last few weeks, but another big list of winners, another big list of newly alerted winners, another big list of newly alerted winners. And we are going to hopefully keep that trend up as we get it going. We've got EPP Panther checking in the Twitch chat. Appreciate the message. I love that people are using the profit tracker as a template. And hopefully everyone that has, I hope it's working well for you guys, but I'm glad that you guys have been able to use what we've got here to your advantage and help you guys with your investing. Moving down and closing the loop here on this weekly recap, RKLY, which is what we mentioned, that was another iView reversion opportunity where the chart spiked up on news that I think they would be used by Apple for their technology. That's what we saw right there, right? So they were trading around $7 a share. They had some Apple rumors, shot up to about 10 a share, and we were still able to get some profit down at, still able to get some premium down at 750. And you can see that red line right there. It's our break-even price. And that falls right in line with the base on the chart. So that is a really solid setup for the iView reversion opportunity. We jumped all over it, and we're seeing some really nice profits on it so far. And I don't want to speak too soon, but I would hope over the next 5 trading days that the 750 price level we're seeing right here is going to hold. So jumping back here, JOBY, same deal with that one. I think that finished just under 950, so that's going to roll forward to next week. We're going to hope that expires worthless. Riot Blockchain was one that had a pretty sharp drop. We don't typically get involved in too many crypto stocks, and I might get torn apart in the chat for saying that. But we saw an opportunity that we liked. There was a sharp drop during the week. We could take a look at that one specifically. There you go. You can see that red candle right there. If we zoom in on the 20-day, you'll see the big drop off that we had right there. And we got in and out really quickly on a weekly 27 strike put. And when you have these big drops, you can see the spikes in implied volatility and the subsequent drop off in implied volatility, which kills the option premium. And that is exactly what we are going for with this strategy. So we were able to scalp a quick, $100 off that. And that type of trade, really speaks to the diversity of strategies that we're using on a week-to-week basis, right? So everything that we use is option selling, But as hopefully you've seen as we've gone through this weekly rundown, there are different ways and strategies to use option selling, right? We can use longer term expiries where we expect a drop off in implied volatility. We could use week to week high IV trades where we're scalping, $200-300 at a time and hoping those add up. Or we could, have these day trades where we're just scalping things off small spikes in premiums and getting out when we see some profit that we like. ZIOP, another one where we had that come up on one of the scanners that we threw together. So that one looked like a decent value for us because I think the stock was trading at 220 and max profit was at 2. Yeah, it was right around here was when we opened it. But, it has since dropped below 2. But as we know from the red lines, anything above this is max profit. But anything above this is going to be a break even. Or excuse me, this is our break even. So anything above this level, we're going to be making money. So while it does suck that it dropped back below 2, we're still in a position to make money here. I'm going to keep holding it and just see how this one plays out. Because I guess when we talk about entering into trades like this, we always want to have step 2 and step 3 potentially in our minds. If we look at the trade tab here, we go to October. 50-cent intervals on the options are exactly what you're going to want to see. We can enter into a 50 put and then 2 strike call coverage strangle, where we would get between about 12 cents on the put side and maybe 30 cents on the call side. So that's about 42 cents a premium, which would directly be deducted from this break-even price right here. So our break-even would be around the 130 area headed into mid-October if we did need to take assignment on this. But I'm perfectly happy if it finishes anywhere above $1.75 a share this week. I'm going to close that one out for profit. Not too much else to talk about on this one. NRXP has a surprising amount of premium, I do have to say, going into the final week of expiry for that one. NRXP, nice spelling by myself there, NRXP. And you'll see there's been a pretty steep drop off from the 17 level, and this happened because they announced, you can see this big red candle right here is from when they announced a share offering, but there's also been a pretty big surge in implied volatility. Do I know the answer as to why that's happening? They're presenting in an investor conference sometime next week. We could pull this news on the screen between September 13th and 15th. So that's going to be between Monday and Wednesday. And I doubt that's something they would do if they were going to unveil some bad news or anything like that. But we're going to hang tight. They've had 2 share offerings. The first you can see right here was back mid-August. And the second was this red candle we just highlighted about 5 days ago. So the fact that they've had 2 different share offerings means that they've raised a decent amount of cash, but more importantly, it means they've raised it at these levels. So I would expect the dilution that comes with share offerings to hopefully steady out this stock a little bit. So our max profit point of $10 a share right here come Friday afternoon hopefully is relatively safe, but we'll see how this one plays out. Tons of premium on these. So even if we do have to get assigned, if we take a look at the calls for next month, we could sell a 10 strike call if we wanted to for a couple bucks and get our break-even price down to 8 as we head into October. So not one that I'm terribly worried about. The plan there will be just to take assignment if it does pop below 10. And I think we sold those for about 25 cents a share, 25 cents a piece, those options. So anything above 9.75 will be profit. We'll close out. So that is it for the weekly recap. Once again, market dropped 1.7%, which is a decent pullback in the market. So the fact that we were able to stay green at all, I think is a good testament to the effectiveness of our strategy. We're always happy to have a green week, even more so when we do it in the face of a week that is this red. That 2.37, percent outperformance against the S&P 500 is something I'm really proud of for the past week. And hopefully we could keep it up. If we just do a quick high-level summary of how the year's been going, we have not lost money a single month on the year so far, coming up on $75,000 of profit. But more importantly, it's 86.59% return. I guess these numbers are here for transparency purposes and position sizing when you guys follow along. But the most important number of all right here is that percent return, because we may not always be able to get the same dollar value. You might be able to get more than me. You might be able to get less. But what we can all accomplish together is this 86.59% return, which when you compare that to the S&P 500 so far this year, we are outperforming by a wide stretch as we head into the back end of the year. We got Escota82 popping into the Twitch chat. How's it going? The Discord chat's #1 Chick-fil-A fan. We'll give her that title. But yeah, that is the weekly recap. We've put together a really nice stretch of weeks, and I think talking from a broad perspective, this is a good time to maybe take a look at our account balance chart. And in July, we started getting really, really cautious about the overall market because we talk about this every single week. If you look at the S&P 500, we're going to use the SPY ETF. I mean, take a straight up under a year. If I can get this up here, there you go. I mean, there really hasn't been a sizable pullback. We've got this big red candle right here, which is about as big of a red candle as we've had in a while. But still, if you look in the scheme of things, we back up to the 3-year chart. What is typical in the market, we haven't really seen. There's this pullback back, September, October of 2020. We are pretty far removed from that. We're very far removed from the COVID crash. And it just seems, this was back in 2018. This was a big pullback in the last quarter of the year. I just would expect to see something like that at some point in the near future. And with how high things have run up, I just would be careful that we might see a pretty big fall back down. So we always want to be prepared for that. We always want to have a good amount of buying power free. So as you can see right here in July, our profit and loss got a little more stabilized because we took that approach of reducing the amount of buying power that we have in play. And I've really enjoyed how that has played out so far. And I think it has saved myself personally a lot of stress since we are no longer in the roller coaster that we saw between January and July for the first 6 months of this year, which was pretty interesting at times, right? It was fun to make all this money up front, and then it's never fun to have weeks where you lose $9,000, $7,000, $15,000. I mean, we eventually did get it all back, and it was all in all a good performance. But I figure, there's not a price you could put on saving myself the heart attack that these drops were causing myself on a week-to-week basis. But with that in mind, we had made the point on these streams throughout the year when we've been recapping how we've done so far that, 3 weeks in a row of profit was really the record that we had, because it seems like every time we would get 3 consecutive, if we ever did get 3 consecutive, it would be interrupted by a loss. But ever since the beginning of July, when we switched gears a little bit, we are now in a position where over the last, how many weeks is this right here? Over the last 9 weeks, we've only had 1 losing week. And I guess that's preemptively including this right here. So I should say over the last 8 weeks, we've only had 1 losing week. And the magnitude of that losing week is smaller than our smallest winning week. So that's another super important thing, right? Realistically, we're not going to make money every single week. It's great that we've made money every single month. Do I expect to keep that up in the future? Absolutely not, because that's just the reality of the market. But we're going to try to keep it going as long as we can. And the best way to keep that going is knowing when to take losses. When you have a losing week, don't let it look like this, right? Because a $15,000 loss might take you a little bit to come back from. But a $689 loss, we could redo that in one trade. It's just a matter of being patient. It's okay to have a flat week. It's okay to have a slightly down week. Just stick to the plan. Make smart trades. Smart trades aren't always going to work every single week, but in the long run, things are going to work out for you. So that is the end of my little spiel. And before we get into the second spiel, where I think we're going to talk about some credit spreads, using credit spreads to pay for debit spreads. We're going to talk about Rocket Mortgage because that one was just thrown in the chat. We're going to go through our scanners. We're going to talk about the upcoming earnings that we have in the market this week. Very brief self-promotion here of our website. If you go to hourglass-trader.com, if it loads right here, hopefully the internet can do its part here. You have the link to join our Discord server where, as we say every single week, we can only come up with so much on Sunday nights. There's so much that happens on a week-to-week basis. There's so much that we alert on a week-to-week basis, but if you want to get all of our trade alerts, that's where you sign up. Click here to join HT Premium. There's a week free trial. If you use our Webull referral code, you get an entire month for free, so that's a great way to at least try it out without a financial commitment and see if it's right for you. Comes with our trade alerts, comes with trade plans. For example, if we go down here, we can see the Rocket Lab. Everything that we basically just talked about for Rocket Lab, we laid out. I guess that link isn't working. That's great. There it is. Okay, it worked. Everything that we had laid out for Rocket Lab, and I accidentally clicked away from that again. Impressive. But everything that we just talked about for Rocket Lab was laid out in a blog post about 3 days ago. So not only did you get the alert that we got into that trade, but we had some analysis about what we were looking for in that trade, what we were seeing. The precedent was SoFi that we had right here. So not only are you getting alerts for the trades that we're entering into, but you're getting some sort of justification so you could also understand why we're getting into these trades, because that's, it's one thing to just blindly follow, but I think it's so important to understand what we're doing and why what we're doing works if you're going to follow along with this trading strategy. And I think the HD Premium package is a great way to do that. We're about to take a look at some scanners. If you go to the option scanner page, we're going to have direct links to what we use on here. And I'm going to stop droning on and on about this, but that was the one quick spiel. If you are not signed up for HD Premium, hourglass-trader.com homepage, click on join HD Premium, and you'll get everything that we just talked about and some more, because I don't want to spend too big of a chunk of the stream talking about it. So on to the stuff that you guys will probably find more interesting. What are we going to do for the upcoming week in the market? As we talked about, most of what we have is either a continuation of opportunities that, expired last week and still look good for this week, or things that look like they're reasonably going to finish above our max profit point, like RKLY and JOBY, where we're letting them expire worthless. So I guess what can we add, right? We're only using about 38.96% of our buying power right now, so we have a good amount of firepower on the sidelines. But I think now is also a very good time to remind you that cash is a position too, right? You don't need to wake up Monday morning, 9:30 Eastern, and say, okay, I'm going to spend every single dollar I have right now so I am loaded up with trades on the week. Because if Monday or Tuesday are really red, you are going to be fighting a margin call as opposed to, licking your chops and getting ready to enter into some very nice entries. So that's something that we definitely want to keep in mind as we move forward in here. So to kick our trade ideas for the week off, we are going to use S. Kotha's recommendation here to take a look at Rocket Mortgage, ticker RKT. And before I keep going, I'm going to take a quick sip of water. Unfortunately, I think my refrigerator is broken, so it's not in ice water tonight. We have no ice in my house right now. All right, so not quite as refreshing as it normally is, but, there are people with no water at all, so I can't complain. All right, moving into the 180-day chart is a place that I always feel is a good spot to start off. I think first thing that sticks out to me, one is, the implied volatility dropping off a little bit down to 0.48. So Rocket not as good as an option selling opportunity as it has previously been, but that's not to say that there isn't a good opportunity at all, because what sticks out to me on the 180-day chart right here is that the low is 16.22. It closed at 16.66. So I have a hunch that if we took a look at our favorite study, RSI, if we go under the R right here, RSI, we're going to see, there it is. RSI is in the oversold blue territory below a 3 on the 180-day chart. And why do we like RSI so much? Because on a short-term basis, it's probably one of the best technical indicators out there for predicting a rebound. And that's the exact kind of price action we're looking for when we sell cash secured puts on that neutral to bullish strategy. We love a rebound because we'll be cruising to max profit. So if we, let's take a little bit closer of a look, the 20-day chart right here. You see this big red candle at the end of the day, Friday. I wonder if there was any news that caused that. And I can't say it looks like there was any news. It looks like it might have just been a general end-of-week sell-off. So with that in mind, let's take a look at the option chain for the upcoming week. Where's the opportunity? Let's cut this down to 14 strikes so you're not getting killed by numbers. And these look really, really strange because they had I think some sort of dividend that messed with the strikes of the options. But, we'll talk about them. That's why you have these 0.89 intervals on the strikes, which are really strange. But you still have your standard 50-cent intervals. If we take a look at, 16 strike, which is below that 180-day low that we talked about at 1622. So you theoretically could have some decent support right there. Those are offering 0.82% per week. And again, one of those things where we have this discussion all the time as well, where that might not seem like the biggest gain of all time, but it's really not bad. Let's see what the margin requirement situation is looking like. We know that it would take $1,600 to sell one of these fully cash secured. And it looks like with margin, it requires about 33% of that fully cash secured amount, requiring only $602. So it's about a 2.4% return on capital, which is, not too bad. And that just really begs the question, is Rocket Mortgage a company that you're going to want to be holding in the near future? And to me, I think this is a very, very, very good entry point, because you can see right here, there's another little bit of support back in November of last year before it bounced again. Between mid-May of this year. So from an entry perspective, I think it's great. You really have to make the personal decision about whether you think this is a stock that you want to hold at this price. But as far as option selling, I think 16 is a great place to start. You could maybe get more aggressive and go for the 16.5 strike, which would stick you, 16.5 strike minus that roughly 30 cents a premium would stick you at a 16.2 cost basis. There you go, bingo, right on the number right there almost for that 180-day low. So, I don't hate the idea here. I'm not, in love with Rocket Mortgage. I've got a position already in United Wholesale Mortgage, so I think I might cut the exposure to that area off right with that one. So that's not one I'm personally going to be entering, but if you're looking to enter into a position, this really isn't too bad. I think it's one of the safer ones, especially compared to some of the other stocks that I've seen thrown around. And speaking of some of the more dangerous stocks that have been thrown around, we've got a call out in the Twitch chat for SPRT 20 strike puts. We've also got him here in the YouTube chat saying that he's waiting for the face reveal, and I don't know, it might come one day. I think we might be coming around to getting a webcam. We'll see. Might need to get those viewer numbers up because I don't want to be no face reveal to nobody. But we'll get it's definitely on the radar coming up. Escota asking if you already have stocks, what would a good strangle be? Great question. I think some of that could be partially dependent on what your break-even price is, because I imagine if you're holding stock that you're probably sitting on a little bit of a loss right now, since in the last 20 days we've seen some really big downside movement. But maybe get aggressive and go 17.5 or 17 on the shares just to knock 10 cents off that basis, and then maybe more conservative on the cash secured put side for another 12 to 14 cents. So if you sold a 17.5 and 16 covered strangle, you'd be knocking 20 cents off that break-even price. You said your break-even's at 24. That could use some work, but I think as long, I like the idea of the 16 and 17.5. 20 cents per week, isn't a monster number if you really want to get conservative and drive that down as much as possible. It just really depends on your personal opinion. Do you think Rocket Mortgage is bound for a little bit of a rebound? Because if so, you don't want to limit your upside too much. And if you do think it's going to hit a rebound, maybe getting more aggressive with the 16.5 strike put would do a good job of lowering that break-even price more effectively. Okay, we've got a question from Todd in the YouTube chat, but we're quickly going to talk about SPRT before we get to that question. And this SPRT discussion will not take long at all, because the question was, I'm going to pull this back on here. Question about SPRT 20 strike push, just had a gap fill, which should be support. Break even down at 16 if assigned. So let's talk about the support level on SPRT. For starters, this is just the 20-day chart. This is the last month. There is not support at $16, so that'll be the first thing that I say. Right? Excuse me, that's not what he said. He said gap fill, which should be support right here, I guess, is at 20 is what he's proposing. However, 20 days ago, this stock was at $7.50 a share, which is 60% lower than what it is currently trading at. So I would not consider $20 a share to be any sort of reliable support on this one. Haha, support. Anyways, if you back up to the 1 year chart, it looks even worse, right? On that 20-day chart, $7.50 was the low. The 1 year chart, $162 is the low. And I think even if you go on the 180-day chart, which is half that, you have a $1.90 low. Just before this green candle that they had back in March of this year, so 6 months ago, this thing was trading under $2 a share. This is a great example of one of these things that's going to show up in your scans on a week-to-week basis because it's offering some obnoxious returns on capital at risk, but it's offering those for very good reason, and it's because this right here that you're looking at on this 180-day chart is your downside risk. If you sell a 20 strike put for $430, $440 of premium, and you get assigned with a 1570 basis, congratulations. Your basis represented by a red line right here on a stock that potentially could go down to this level and would have you looking at a 50% plus loss on those assigned shares. So when we got back to that discussion after our weekly recap talking about, hey, we've had a lot of good weeks lately. We had one small losing week. It's important to limit the magnitude of the losses. The best way to do that is to avoid sticking yourself in situations like this that have the potential for that 50%, 60% loss. As long as, with the setup we had with Rocket Mortgage, we saw that we were at a really long-term established area of support. There is some decent premium on a week-to-week basis. Those are the safer trades that are going to compound into some really nice losses and prevent you from finding yourself in a situation where you might be getting greedy and chasing the premium at a 20 strike put and then be staring at a pretty sizable loss on a week to week or month to month basis if this thing falls back down to where it's been trading for the last few months. So SPRT, that is not one that we are going to be going for. Then we had a question from Todd Miller in the YouTube chat saying, are there any strategies you have a stock and the covered calls aren't doing much to lower the cost and you don't want to take a loss? In that situation, I think the general advice that I give is that while I think option selling is awesome, it's the only thing that I do in my trading account, and it's probably the only thing that I'm going to continue doing, it's not the best strategy for every single situation, right? It's not really a one-size-fits-all approach because, as you point out, sometimes that premium does go away on the stock. And personally, what I do when that premium disappears is I just get out of the position because in investing, no one on earth knows what a stock is going to do from one day to the next. People might have their different technical indicators that they think are going to tell them what something is going to do. People might say, oh, it's done this a million times before, this is going to do it again. You know, those might help you make an educated investment thesis, but at the end of the day, no one has any idea what's going to happen in the market. So that's why anytime that I enter a trade, I do it from an option selling strategy because those inherently have cushions on the downside. So if you're wrong, you could still make money because really we're all just guessing out here. So I, at the very least, would like a cushion if I'm wrong. But back to the point on that question, when I don't have that cushion anymore because the options on a week-to-week basis aren't offering and those covered calls aren't offering very good premium, I just get out of the trade. And if it's something that you don't want to take a loss on and you still are believing in the stock, it might be a good idea to, one, sell some more cash secured puts to potentially, size into that and get some more option premium on the side, regardless of how small that option premium might be. But other than that, you could just straight up buy and hold the old fashioned holding the shares and waiting for a rebound or for a return of that option premium that was previously there. Now, I know I mentioned my personal preference is just to get rid of it because I want that little bit of a cushion on every single trade that I make. But if you're a big believer in a stock and you don't like the premium it's offering, you don't want to cap your gains at a certain level, then by all means, take a few weeks or a few months off of selling covered calls on that stock and see how it plays out. That's a perfectly valid decision to make. So with that said, we CAT, we've got another suggestion. Caterpillar. So I'm hoping Jerry in the YouTube chat was shouting out Caterpillar stock. If not, we are just talking about felines, and I've completely misinterpreted this message. But we'll take a look at it. Trading again, another one that's near that. It looks like a 205, 204 base that's been established in this area. We take a look at RSI on the 180-day chart, getting down to that oversold area again. But what gets scary potentially if we draw a line here at 205? What happens if we extend this to the left? It looks like the gap down might only be to about 198. So I think anything, if we take a look at the options on this one, with the break even around 198, 198, 199 is going to be decently manageable. And if we take a look at that, there are some options right there, right? You can get a 0.61% weekly return, which again isn't a huge number, but Caterpillar is a more stable stock, so it's a lot less likely to completely shit the bed on you and leave you bag holding. And because of that, you probably have some decent margin requirement, right? If you wanted to sell one 200 strike put, fully cash secured, it would take $20,000. But if we take a look at the margin requirements here, it only takes $3,500 for us right here. So about a 17% margin requirement as compared to fully cash secured. And so we could, when I calculate all these returns on capital using margin, we could go through my favorite exercise, which is bringing the good old PC system calculator out onto the screen and saying, previously that 116 gain that you could see right here would be divided by that full amount of collateral, that 19,884. So there you go. It's a 0.58% gain, and I think this uses the midpoint right here when it calculates 0.61. So that would be the return if you sold it fully cash secured. But again, the advantage to using margin for something like this is instead of this $19,000 denominator, you're now in a situation where you would get $116 of profit per contract sold, and it only costs $35.99 to sell a contract, and you're now looking at a 3.2% return on a week-to-week basis as opposed to 0.61. So it really jacks up those return on capital numbers. Really, the only caveat to that, and what I would caution you if you did try to go that route, is just to make sure you're always cognizant of what this amount is fully cash secured, because if the market decides to tank this week and you're assigned all these Caterpillar shares, you definitely want to know how big that position is going to be. We got a good question in the YouTube chat about this topic, about this margin, right? So looking at the rocket buying power effect, for me it was 602. However, for her in the YouTube chat, or him, excuse me, to be honest, I don't know. Feel free to correct me. But to them in the YouTube chat, it was 1588. So here's what we can explain why. They have level 3 options approved, and we could bring up this example again if we take a look at RKT. 16 strike. There you go. It was, or I guess if we were doing one contract, it would only be, 602, as opposed to where the commenter was saying that it took them 1588, which is that amount you see right there, fully cash secured. So the answer is that you're either not using a margin account, or you're not approved for, I have advanced margin on this account. So there are different levels of margin, right? There's just, standard margin. There's advanced margin, and then there's portfolio margin, which is ridiculously insane, which I do not use. But I think advanced margin is helpful, and it comes with the options level that lets you sell naked calls. So the advantage of that is I get some really nice margin buying power privileges like what we see right here. But, it lets you sell naked calls. But, in the context of our strategy, we never want to sell naked calls. So if you're someone who might not be able to stay away from that temptation, it might be worth it to just not jump in on that. But if you're decently disciplined, you think you can make some really nice money with the leverage that this provides you with, and I think you can, which is why I personally have it enabled. That's something you could look into, that advanced margin on TD Ameritrade. So hopefully that answers that question. But moving back down, I think we've pretty much talked about everything on there. We've had a couple suggestions from the chat. One quick thing, I know I mentioned we were going to talk about earnings. If we pull the Discord server up here, we could go to our earnings plays channel, where every single week we post the earnings that are coming up, and there really aren't any that are too interesting, right? Oracle is really the only big name company that we have on there. But with these weekly earnings trades, what I like to do is either I'll only sell options on earnings that occur Wednesday after close or later. The reason being is because after earnings, we know that there are big drop-offs and implied volatility, and that sharply decreases option premium. But the other thing is that, when you combine that sharp decrease in implied volatility with the advanced theta decay, the more exponentially increasing speed of theta decay at the end of a week, you get yourself in a position where you could sell some, decently safe puts or, call spreads on earnings results that are, Wednesday after close or later, combining that 1 to 2 day to expiry window with that drop off in implied volatility. And as we can see right here, there's literally nothing reporting in that window. Oracle's at the front of the week. We could take a look at that one really quickly, just because that might be a name that some of you guys are interested in. And here we go. We have a few more messages in there. I think if you add the ROC column in the, so we had a comment in here saying if we add the ROC column in TOS, it should calculate the returns using margin. The caveat to that, and it's a good point, but if you put return on capital, it calculates it as if you get, I think, 10 to 1 margin or 5 to 1 margin on different stocks every single time. So for some of these, like if we take a look at SPRT, for example, you see these insane ROC numbers. But if you take a look at the buying power required, it's required to be fully cash secured. So unfortunately, for whatever reason, that ROC column doesn't actually take into account the buying power effect. It just, I think, blindly uses the same 5x or 10x margin privilege per stock. So I thought that was super useful when I found it. I had the same thought, but unfortunately it's not as useful as it appears. We've got more for saying don't forget the credit spread and then the debit spread for Emily. You know what? I think now's a good time to take a look at that one. So we have someone named Emily, new face in the Discord server, and I think she's here on the stream tonight because she dropped a message in on the front end of the chat. But she has an investment thesis that Boeing is going to go down to $160. Is Boeing going to go down to $160? That's a pretty sharp drop off in a pretty short amount of time. If we go to the 1 year, maybe. I mean, the top end of the range right here, if it gets below this level of support at 190, you don't get too much support until 170. So, I mean, it could get down to the range and test it. But let's say that we did have this investment thesis that we thought Boeing was going to go down to 160, and we'll say we think it's going to happen in the next year or so. So what I would always recommend is a credit spread, right? So we would go switch this over to vertical. We'd go out about a year. Not a year. We'll use January. We'll give it a 4-month timeline, which is, a lot, not a lot of time for that big of a drop as we saw on the chart. But if we thought it was going to go down, from a purely up or down perspective, we would sell a 210, 215 vertical call credit spread. In plain English, what that is doing is basically betting that, hey, I think the stock is going to be below $210 a share come January 21st. And when we do that, we can get a 262 credit on a $5 wide spread. So what we know about that is if we get a 262 credit, that means, there's really only, I guess, an easier way to show you this, the profit and loss here. We're going to risk a $2,380 max loss for $2,620 max profit. So what we're taking is theoretically, a 50-50 bet. Is it going to go up or down between now and January? And since the market typically goes up in the long term, it's not quite a 50-50 bet, which is why you get paid out better than even odds for the bearish position right here. But, the question is, yeah, I'm betting on it to go down, but, I want to bet on it to go to 160. And I think a vertical call spread, if I do something like this, right, I'm getting paid out under 210, but I really want to get rewarded in the case that it goes down to 160. So I think the best way to visualize this is going to be to pop on over to optionsprofitcalculator.com, which comes up when I type in O. Nice. And we'll take a look first at this call credit spread. We'll do credit spread. We're going to do BA for Boeing Airlines. And I'll try to zoom in a little bit because I feel like sometimes this can get pretty small on the screen. And we'll know that we write the 210 option for January. If we scroll up to here, why isn't it letting me scroll up? I'm zoomed in too much. I've made a huge mistake. Maybe it won't let me. That's really strange. Let me try this again. There we go. Okay, so for January 2022, we're going to write the 210. We're going to get the 1868 credit, and we're going to buy the 215. And that's going to give us, there you go, that 263 credit that we saw. And we're going to calculate it. And this is what that risk to return profile looks like. Let's make the lower end of the range here 160. And let's update the price range. So there you see it, right? We made this bet that Boeing is, because we have this investment thesis theoretically that it's going to go to 160. And again, disclaimer, that's not our personal investment thesis, but if we were playing that idea, this is how you would do it. But again, we might say that, hey, this is great and all because I think Boeing's going to go down, but I want to get paid out more than 50% if I'm right about, a 20% pullback in the stock here. So how would you do that? If you wanted to enter into a debit spread, that's something you could do, right? So a call credit spread is bearish, but the other side of that is a debit spread. The put spread is bearish. It's a bearish put spread, meaning it's a debit spread. But we like credit spreads because if the stock stays flat, we make max profit. Why do we not like debit spreads? Well, let's take a look, right? What you would do is you would write a, let's see. Let's play it 70-75. You would write the 70 strike put, and then you would buy the 75 strike put. So if we calculate this, it's a debit spread. You see that right there. You really need this. Oh, whoops, I clicked 70. No wonder those were so low. Okay. 170, 175. We've got a comment already telling me the option strat is cooler than options profit calculator. That may be true, but I've never used option strat before, and I do not want to look like an idiot technically live on the stream. So I will try to maybe learn that one this week. But again, what you get here, right, is an 88-cent debit, and the outcomes are a lot different, right? So before the bearish position that we had, you made 50%, right? Well, I guess you really made 100% because you made more than you risked. You made 111% anywhere above 210. But with this one, you get into the position where you start making 355%, 468%, and 468% is the max profit on that trade. But, that's the difference, is the fact that you get paid out more if you're right about this. But one, the likelihood that gets down here is very small. The likelihood that it finishes in this range is much higher, which is why we are partial. If we go back and write this 210, 215 call spread, That's why we like this outcome a lot more. There's a lot more green here. It's a lot higher of a percentage play, and that's why we like to enter into these call spreads. But let's say, you like the call spread, but at the same time, like we mentioned, you want to get paid if this thing really starts dipping. So this is where we get into the idea of using the credit that we receive right here, this 263 credit, to pay for a debit spread. So we're going to enter into a 4-leg trade here, and it's going to be on Boeing Airlines again, BA. We're going to write, same thing. We're going to start off with this January 2022. We're going to write the 210, buy the 215 behind it to create the vertical credit spread. And we're going to do this range from about 150 up to whatever. Calculate it. It's going to make me fill it in. So again, we remember, if we click here, we remember what we had right here with the 210, 215. This was our outcomes, right? It was 111% return no matter what below that 210 max profit level. But we want to get more in case we're super right and this thing drops down to 160 as the hypothetical investment thesis stated. So popping back over here, we have that same call spread. That's going to be the same 111% return below 210. But in order to increase the payout, we're going to buy that put spread that we talked about off the bat. And we'll remember that it was an 88-cent debit, meaning that we pay 88 cents really to get it. But you'll remember this is a 263 credit. So what happens is the overall effect of this, if you sell a call credit spread and buy that put debit spread, is you get this 263 credit net against the 88 cents you pay, and you end up with a dollar, I think 80-ish, about $1.80 credit overall. So you're in a position where you have an overall credit, which we love, meaning it's a position that derives its value from option selling, while you still get the benefit if you are correct about this sharp downward motion. And to avoid myself continuing to just talk about this over and over, let's actually put the legs in on here. So we're going to go 170 is what we're going to buy. And we're going to buy, and then what we're going to want to write is going to be we'll do the 165. We'll do the 165. So let's see how that looks now. So, we're going to make it a little suspenseful here. We'll slowly scroll down. So this is great because we remember when we had that debit spread up, we didn't make money until it got down to like 165, which is a huge drop. But now we're in a position where, again, as long as it finishes below 210, we're going to be making money. Now, our max profit isn't going to be 111%. The compromise here is that our max profit is 57.7%, and I shouldn't say max. Our profit below this 210 level is 57.7%. But the great part is once you start getting into this range where you think that the stock is going to go down to, you now open yourself to a potential 215%. So using a credit spread to pay for a debit spread takes you away from that initial position where all of this was red and it was really low probability that it got down here, while still giving you the upside that we had with this initial credit spread, right? Where we saw that if we run this one again, straight 111% return, but our investment thesis was, hey, we think this is really going to tank. We want to get paid out more if it does tank. So using the credit spread that we have here to pay for a debit spread that's an 88-cent debit lets us keep a position where there's an overall net credit and gives us that escalated payout if our investment thesis pans out. So, at the very worst, if it goes down but doesn't go down enough, where initially we'd be looking at 100% loss, we now get to take home a 57.7% gain. And on top of that, if our thesis is correct, we now get a 215% gain. So it's twice as much as the original base profit that we had below 210, while just sacrificing about 43% of upside in this range right here. So that is the idea of using a credit spread to pay for a debit spread in a situation where you are really, really confident that a stock is going to move a certain direction. But at the same time, we want to keep that smart, high probability option selling idea in our potential outcomes so that if, as long as it moves in our direction, period, that we get to make money. And that is how using a credit spread to pay for a debit spread works. So we've got a suggestion for PSFE. Let's take a look at that one. PSFE, I think it's pay safe. This one comes up sometimes. Every now and then. Here we go. And this comes up a lot because I don't want to jump the gun here. I think this may have been a former SPAC. Let's see. Maybe not. I don't see SPAC mentioned anywhere in here. I have no idea. I could be completely wrong about that. It doesn't matter. Here's the chart. It looks like it had a base around 10 starting in October of last year. It went up to 20, all the way back down. And I think the last time we talked about this on stream, it was up in this area. And I caution about this all the time. And I feel like I sound like a broken record, but I promise it's because I care that we don't have a bunch of bag holders in our group. But when you see a stock like this where it jumps from 10 up to 20, just be patient, wait, let it come back to you, because it would suck if you got in at 14, 15, 16, and you've basically spent the last 6 months holding the bag and trying to manage your break-even price on this one. But now that it's down at 854, a much better entry opportunity. If we pop over the 180-day chart, looks like it was even overbought at one point as it bounced back up near 960. But again, that low of 840 looks like it might be forming a bit of support. With all of this movement up and down, definitely interested to put the implied volatility up there. See how that looks. And, big drop off between March and, I don't know, April right there, earlier this year. But it looks like it rose back up a bit after what I would have to guess were some pretty poor earnings, as it had a candle down from 11 to about $8 a share. That's never great. But what's great is when we start looking at it right now, as opposed to August 11th, and try to take advantage of this big drop. So let's take it off the spread, since we were just talking about this. Let's get this trade out of here, and let's take a look at what's going on for the upcoming Friday. So again, 8 strike is where we thought, this is probably a decent cushion if we zoom into the 20-day for a little more short-term price action in our analysis right here. This $8 base looks really nice. It was just getting back up to test the $10 level again. So there's definitely a little bit of life in this one. I don't know how much of a dead cat bounce that was or was not. But 0.69% return, that's not enormous for this kind of volatility. Let's see. They do cut you a little bit of slack on the margin department. So it looks like this ends up being about a 50. I don't know. It's late. Let me do this so I don't just completely mess up the mental math right here in front of you guys. A $50 return divided by what would be an 1157 requirement is a 4.3% weekly return. And that's a really nice number. Now the question is how much you want to use that leverage, because this doesn't look like it's been the strongest stock in the world. So I don't know how much I'd like to load up on like a huge position if fully cash secured. So that may not be the route I take. But again, if that is something that you think is nice, because again, a 0.69% return, nice, is a, actually nice, unironically, return on a week-to-week basis from an ROR perspective. But when we do enter into that, if that is something, a route that you decide that you want to take, we want to have step 2, we want to have step 3 in the back of our head before we enter into that. So let's take a look at what the October options are looking like. And there's definitely a decent amount of premium on the upside here, with about 45-ish cents of premium on the call side, right? So if you sold the 8 strike put, it did get assigned, you'd have a $7.95 basis. You could maybe get away with about 40 cents of premium to get you down to a $7.50 basis headed into October. But if we take a look at this chart in the context of the last 180 days, is a $7.50 projected basis really that great for something that's gone from 20 down to 8? I don't know if that 50-cent cushion is going to be enough for me. I just don't know enough about the company. But if this is one that you like, it might be a better idea just to, instead of starting off with the cash secured puts, potentially taking advantage of some of that call premium that you got right there, maybe going in on shares and trying to hit the rebound up to 9 or 10 this week, or even going a little further out to October to get a little bit more premium on that one. But again, on the front side of this, your break even is always going to be better if you start out with those cash secured puts and get assigned at that favorable basis before going into step 2, which for us is the coverage triangle, where you sell cash secured puts and covered calls at the same time to aggressively lower that basis. But for me personally, the way this chart's looked, I don't know a ton about the company. The amount of premium we're seeing right here just isn't doing it for me, and I don't really want to be someone who's using that leverage to get a big position on this, because it just doesn't look like the strongest stock in the world. When I use those big positions, it's because it's something I'm super confident in, like with Rocket Lab. I would be perfectly happy to throw cash at that at a 670 break-even price. So that's what we did when we loaded up on that one. Next suggestion in the chat. Jerry's on fire in the chat with HITI. And wow, this thing is okay. What on earth is this? High Tide Inc. Let's take a look at analyze. Fundamentals, HITI. And again, this is where we go and take a swim and we don't know what something is. Healthcare stock. So again, I think the spiel we go on a lot in our Discord server is because of moves like this, we really do not like to get in on healthcare stocks. And it looks like implied volatility kind of is what it is, right? It's leveled off in this range. It doesn't look like there's going to be some sort of imminent pullback in implied volatility to give us some sort of opportunity there. But what looks, oh, it looks like there was a stock split right here. Okay, 15 to 1. So what, 50 cents is what it was trading at. If we multiply that by 15, 750 is about the price, and there you have it. So it looks like, honestly, it hasn't changed much at all. However, I typically find that when you reverse split like this, which I would imagine wasn't a bid just to not get delisted, because if you're below $1 a share for a certain period of time, you're at risk of being delisted from the New York Stock Exchange. So a lot of the reverse splits you see are because of that, and eventually lead to just a further drop off in price post reverse split, which is what we see right there. So typical behavior post split, that's pretty bearish for me. If you look at the analyze tab, healthcare, that's an area in general that we like to avoid with this strategy that we're using, just because there are so many sharp ups and downs in healthcare. So that's something I like to avoid. But let's take a look at the option chain. Let's see what we're looking at. 750s are offering about 40 cents a premium, which is sticky with a 710 break even. Take a look at the 20-day. That falls right around here, but it was trading at 650 a month ago. So I don't, that's not the safest area in the world. The upside on the October calls isn't really enormous either. It looks like you could only knock off about 20 cents a premium at the 10 strike, and then less than $1 at 750. But again, I'm not convinced that's somewhere where I would want to be owning this stock. So I would stay away from that one. And with that said, let's get into some of our own trade. We're going a little bit over an hour so far on the stream, so we'll probably look to wrap it up soon. But let's take a quick look at what we've got going on in the scan. And what we're doing right here in our scan, again, this is one that you could pull down from our website at hourglass-trader.com. I've already closed the tab, so you are not going to be subjected to more of my self-promotion here. But if you do want to get alerts to all of our trades as we make them, in addition to some background information behind the trades that we make, you want to get instruction on how to build these out with links to add them, so you can conveniently go to load and have all of these at your disposal for a list that will be growing again in the future. You could sign up for HD Premium at our website, hourglass-trader.com. Free 1-week trial, free month if you sign up with our Webull referral. So at least there are some decent options for you to get your feet wet and see if what we're doing is something for you without making a financial commitment up front. But with that said, let's get into the scan results. So ROR, there's some monster RORs right here with SPRT at the top of the list, which is what we kind of talked about and warned about earlier, with the fact that, hey, this is offering an obnoxious return on risk on a week-to-week basis. Not something you want to fall for, right? Because when we took a look at that chart, we remembered that really this range of puts that you could sell for this insane return just isn't something that's worth it. It's not an area that I would want to own the stock in. So that's the number one golden rule. Do not sell options on stocks you do not want to own at that price. So as long as you follow that golden rule, in general, you're probably going to be a pretty happy camper when it comes to option selling. But, you could get caught chasing the bait here if you go objectively at the top of every single weekly scanner and just start selling whatever. That is something I do not feel is the greatest idea. BBIG, same exact story right there. That's going to be one that you're going to see a lot of because it's a social media darling. All those Twitter accounts have been pumping that one. But again, we take a look at the 20-day. I mean, this is nothing more than a $3, $4 stock right here. There is no need to be selling 10 strike puts on this thing because you're chasing a 10% weekly return. Stay away from that one. Moving down the scan right here. MGNX, no idea what that one is. Let's pull it up. Oops, I guess I missed the box right there. MGNX. Macrogenics, and that just sounds like a healthcare stock. But you can see some really strange price action right here as it gapped up from 17 back to 25. Let's take a look at the news to see what happened right here. The stock fell after a study showed breast cancer survival rates for drug didn't pass standard treatment. So, not good news there. Let's back it up a little bit. Pretty volatile stock, although, 20 seems like a decent-ish base. I don't know if something crazy happened after that, but, pretty wide. I'm not entirely sure what you would get filled at.
but I would imagine they probably have some sort of upcoming news here because, as you can see, the expected move on this thing is $7 a share, meaning that the low end of the expected range is $18 a share. I mean, you could sell the 17.5 strike put potentially for a 4% ROR, but again, biotech stock looks like they just got bad news. I don't know if it's something I would want to hold. Let's go a little further out. I mean, yeah, I mean, if it goes 17.5 looks safe-ish. I mean, but I gotta stick to my principles and stick to what got me here. So I'm avoiding this area. Provided it's not like we like to use healthcare for IV reversion type trades, but as far as pure just HT wheel, you're picking a strike, you're letting a week play out. That's typically an area I like to avoid. This $7 implied move lets me know that there's probably some pretty big news coming up for this one, where I wouldn't want to be caught bag holding, even though I'm going to click on this and the margin requirement, it's only 50%. But, not a home run play. And again, the other best piece of advice outside of that golden rule of only selling options on strikes that you want to own stocks at is, what was the other golden rule? I just totally lost my train of thought an hour and 20 minutes into the into the stream. I'm going to keep it moving. Back down on the... what on earth was I talking about here? Confirm, margin, whatever. You know what? I don't remember what I was going to say. So we are going to keep it moving back to the scan. EVLO 7.5 strike put. That's an interesting looking one because it's, below 10, lower entry requirement on that stock, EVLO. And it is Evelo, there you go, Biosciences. So you've got another stock where you see this crazy motion. There was a big red candle over the past week, it looks like, down to 8. Implied volatility is really shooting up on it. So, kind of interesting. They're expecting an 88-cent move for the upcoming week. But it looks like, 750 is where you'd be able to get some premium right there. It looks like your break-even price could be around 670-ish. But, I don't know, you back this thing up to a year. I'm not in love with that right there. And now that I say that I'm not in love with that, I totally remember what I was about to say. And it's that if you are not 100% in love with the position, there's no need to enter into it. If we take a look at our scan, there's 1,000 results right here. There are so many different stocks, so many different options out there, where if you're not 100% in love with the trade, and this applies also to stocks that you're rolling into next week. If you're like, I'm on this trade, but I just, it's kind of for the upcoming week. Cut it loose. There's no need to keep holding on to that because there's so many different trades, so many different opportunities, and we've been scrolling the entire time that we've been just rambling about this, and we still haven't hit anything below 1% return on risk because that's the low end of the scan here. But there's 1,000 different options out there just this week which offer more than 1% return on risk. So if you are not in love with the trade, and then I would encourage you to go back through your portfolio and just objectively really evaluate if you're holding something and you're saying, hey, if I had 0 positions right now and my account were just full of money, is this something that I would open, all else equal? And if the answer to that is no, it's probably time to get rid of that position. So that is the other best piece of advice I think I can impart on this. HIPO, let's take a look at that. I think this is another healthcare one. I may need to find a way to get healthcare out of this scan as well. Really interesting looking chart on that one. Hippo Holdings looks like it's a home protection company. This is incredibly strange. So it's trading around 10, and I'll tell you exactly what this is. This looks just like a SPAC chart, right? You see it leveling off around 10, some sort of merge or something like that, falls off the face of the earth, as happens so often with these SPACs. Let's go to some live news to confirm that. It looks like this drop-off happened around August the 2nd. There you go. Complete the business combination with reinvent, blah, 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 blah. Venture capital at scale. So yeah, this was a transaction, a SPAC type transaction to make them become a publicly traded company back on August 2nd. So not the greatest performance after that, and that's why we caution so often every time there's a SPAC merger, be careful, because this price floor that existed before the SPAC was a merged entity at 10 is no longer a concept when this thing goes public. Let's take a look at the options though and see what we've got on a week-to-week basis. It looks like these 6 strike puts, they're showing is out of the money right now because it went up to 606 after hours. I'm kind of on that. What's interesting to me, though, is these 5-strike puts, because you might say 10 to 15 cents is not a lot right there, but that's a 2.56% return on risk because you're selling them at a 5-strike. And is there potential upside here? I think absolutely. If you take a look at the 7.5-strike calls for October, there's 50 cents of premium on those. So when we talk about planning your trade 1, 2, 3 steps ahead, that would be what you'd be looking at here, right? You would take a look at the 5-strike put. You say, okay, I'm either going to make 2.56% a week right here. And let's take a look, see if we get some margin kindness. Not really. But you get that 2.56% return if you sell fully cash secured. And, one of two things happen, right? When you sell cash secured puts, you're either going to get this return, or two, you're getting shares with the $4.85 basis from which you could turn around and sell covered calls for between 50 cents and $1, which, we could call that about 75 cents because we could sell either 6 or 7.5. Depends how aggressive or conservative you want to get with the covered calls that you sell if we even get to this point. But, with a 485 basis off the bat, if assigned, counting on around 75 cents of premium on the calls means that come next Friday, as you head into October, you'll be sitting at about a $4 break-even price on this, which is right around here. And to be honest, that doesn't look too bad on this one. So to be honest, it's one of those where I don't quite care how bad of a stock this thing might be. The numbers add up in such a way that we could put ourselves in a very, very high percentage position. Let me take one quick look at the newswire again to make sure this thing isn't just a complete dog that's going to be going under bankruptcy or something like that soon. But the big drop looked like it happened. It really did look like it happened just on August 5th there. Nothing looking too crazy here. They raised their outlook on August 16th, which is right around here. And then they had another sell-off, interestingly enough. And I got to be honest, I think after looking at this one, it may not be the greatest company in the world, but if we could find ourselves in a position where, we're either getting a 2.56% return right here, or we're getting shares at 485, selling covered calls for October to get our basis down around 4 right here, I think that's some really solid value. So Hippo is one I would take from that scan and say, hey, it's a good idea. And that's kind of what you have to do sometimes, right? Sometimes you'll have to move down this list. Typically, the ones at the top aren't going to be the best, but if you move through SPRT, you move through BBIG, you move through EVLO, eventually you'll get somewhere like HIPO where, there's, with the numbers, the way they add up, actually offer a decent opportunity from an option selling perspective. And another quick one that I wanted to talk about on there, just because it looks interesting from a strike price perspective, is the NYMX 2-strike put. And again, I have no idea what NYMX is. It's a pharmaceutical company. Yikes. But let's take a look and see what we can see. It's run up from 1 to 205, so it's doubled in about 2 months. So that's a little bit of a red flag there. And then they really only have option strikes every dollar interval. So there isn't a lot of room for position management with that. So if it dropped down to $1.50, what are you going to do, right? For October, the 1-strike put or the 2-strike call aren't going to have a ton of premium if this thing falls back to 150. So every time we see a low value stock with options, when we go to the option chain, the first thing we want to be looking for is the intervals on the strikes. I think BBIG is a good example of one where, look, you've got intervals every 50 cents. So even back when it was trading at these awful numbers at 2 or 3 a share, you still had these 50-cent intervals, so you could have a little bit of flexibility in how you managed that trade. But with that said, we had a couple of good opportunities off the scan right there. I think I like what we've got as we roll forward potentially with CLOV tomorrow morning if we open that one up again. I'm going to have to page down here to the current week really quickly so I could have some sort of visual aid while I finish my spiel as I wrap this stream up. But, I like what we did with Rocket Lab. That one's still trading at 88 cents a piece. Our average on that is 83. So you could still get in on that one tomorrow morning and have a better average than we do and still, have a really nice trade set up in front of you for the next few weeks on that one. ZEV, that's not really one that I would open. We're letting that thing expire. FFIE, I like opening that one. I like opening CLOV potentially tomorrow morning like we mentioned. And if you do want to get a little bit riskier on the biotech side of things, we do have NRXP, which is offering kind of an absurd amount of premium for 1 week left on a stock that's trading at about 12 a piece. So, We'll see how those play out. Again, that's our game plan as we head into the week. Biggest thing right here is we've got a lot of buying power free. So whatever it is that we decide to do, we're going to have the flexibility and firepower on the sidelines to do it. And at a time when the market's looking a little bit shaky, and I think futures are looking all right. They're slightly green. But if you take a look at what happened in the S&P 500 last week, the market undeniably is looking a little bit shaky. So when the market gets like that, having cash, having the flexibility to react to those drops and be able to enter into new trades as opposed to be fighting off a margin call is incredibly important. So that is where our head's at this week. We want to be strategic in what we open. We're not just going to dump all of our money in first thing Monday morning. We love this number right here. And by the end of the week, yeah, it'll probably look something like this because that's what it looked like the week before and the week before. But at the beginning of the week, it has looked like this for the past month or so, and we've come out with some really nice returns and results if you take a look again back at this. If we could keep this up, I will be a perfectly happy camper. But again, that's our game plan tonight. As we say so often, we can only come up with so much on Sunday nights before the market gets started every single week because so much happens on a day-to-day basis in the market. The great part about our strategy is that you could set these things up, not even need to check them. I could do 0 seconds of trading this week, and if these things all don't drop off the face of the earth, I'll end up with what? $1,600. So I think that's the beauty of our strategies. I could spend 0 minutes this week trading, and even if this thing falls back to where we bought it at 0.83, we're going to be looking at a $2,000 return with 0 seconds of trading. So that is the beauty of these, set it and forget it type option selling plays, where you put them in play. You take 5 minutes to set something up, set up a set of plays, or set up your portfolio each week, and you let time and your money go to work for you. You don't need to be glued to the computer. Go play a round of golf. Go enjoy your life and just let these work for you, as you don't need to be, like these other option traders who are glued to the screen looking for the perfect entry, the perfect exit. I love the low stress nature and how these things, from a numbers perspective, work out in our favor time after time after time. So that's what we've got. And like I've mentioned a couple times already, it does move so fast on a day-to-day basis. Trades like this get alerted by us during the week, and they get alerted in our premium Discord server, the premium channels of our Discord server, right? So our Discord server, perfectly free to join. We do give away 1 free trade a week, and the trades that we've had for the last couple of weeks, as they stand, they're up about $570, which isn't more than enough to cover 1 premium membership for an entire year. It's more than twice as much to cover that. So definitely a lot of value, even on the free side of our Discord server, where hopefully if you could follow these, you'll make enough to get in on every single trade that we enter and alert to our premium members. We have all the trade plans that we put in here as well. We have a link to our live watch list that gets updated, and those option scanners that we talked about right there, and a nice premium chat that looks pretty, it gets pretty active on a day-to-day basis. I think we had the stats up there a minute ago. Definitely a lot more activity. There's 9,900 messages in that premium chat as compared to the main chat room, where there's only been about 3,000 in the last month or so. So a lot of activity in that premium section. I definitely think it's worth the value. And even I understand everyone's financial situation is different. So if you can't afford to join premium, there are different ways to get a month free. You could still get a week free when you sign up through our website. Just decide if that's something for you. And I think with the returns that we're getting, that you could clearly see right here, I think this thing pays for itself pretty quickly. And I know that some of our members in there will attest to that. But that is all I've got to say right there. Point being is that as we alert these new trades, that is where they're going to be alerted in the HT Trades channel of our Discord server. So you can sign up for that through our website at hourglass-trader.com. So we are at an hour and a half into the stream. I think we've got some good ideas. We recapped what we did last week. I think this RKLB trade that we had set up that we talked about on the front end of the stream is super interesting, and I love the way that it sets up. We went off script a little bit and talked about how we can use credit spreads to pay for debit spreads and set ourselves up with a risk profile that takes advantage of the benefit that credit spreads give us from an option selling perspective, while still giving us that accelerated upside that debit spreads offer. And we took a look at the scan. We took a look at a couple stocks from the chat, and we took a look at the ones that we were rolling forward on a week-to-week basis. So I think we've got a good amount of info in here. So that is where we're going to cut it off. I appreciate each and every one of you who joined us tonight for our stream. And I will once again sign it off by saying this has been the Hourglass Trader, where as time passes, we make money. Thank you for watching, and hopefully we see you again next week with more money than you had this week. Thank you, guys.